Welcome back. I'm your host Tom Bruni and you're watching another edition of What the FICC, the weekly show where we discuss the most important chart or theme from the fixed income, commodity, or currency space. In last week's episode, we discussed the lack of unity in the crypto market, updating our thesis from July on Ethereum, and outlining where we think the space is heading going forward. If you missed that video and want to catch up, you can click right here. Otherwise, let's jump right into this week's topic, crude oil. Now, crude oil has been on our radar since early June for a variety of reasons. With that being said, last week was a key inflection point, with prices finally breaking their trading range to the downside. So, where has crude oil come from? Where is it headed next? And what are the potential intermarket implications? That's what we're going to explore in this video. First, I think it's important to take a step back and see where we were in late June, when prices of crude oil were approaching a key potential resistance level near 42.5. In addition to testing this potential overhead supply, we saw momentum diverging negatively, and we saw a downward sloping 200-day moving average, which signaled that the long-term trend in crude oil was still lower. But we never got any downside follow-through in prices, and instead they continued to chop sideways and grind to the upside throughout July. That brings us to our second post at the end of July, where we are looking at similar conditions in crude oil, continuing to suggest that a potential reversal was underway. Additionally, we're seeing energy stocks making new absolute lows and struggling to hold on to support. If energy stocks couldn't rally when the stock market itself is rallying and pushing to new highs, and crude oil, albeit not going higher by much, is not going down, well, we took that as a potential signal of weakness in crude oil to come. But again, we were disappointed. Instead, prices went nowhere throughout August and continued to grind higher in the face of those bearish conditions. That brings us to last week, when we finally saw this coil resolve to the downside, and my colleague Steve Straza wrote about it right here on the blog. First, let's take a look at the chart of crude oil that Steve referenced in his post. As we can see, prices were slowly but surely grinding higher, and the pattern was getting tighter and tighter. Additionally, momentum had failed to reach overbought territory during this rally, signaling that buyers had not yet fully taken control of the market. Additionally, we're seeing the one-day rate of change contract to levels not seen in quite some time. So when we get periods of low volatility and they finally resolve like they did last week, we typically see them expand very aggressively. The next chart that Steve had was interesting as well. He pointed to the continued weakness that we're seeing in energy stocks relative to crude oil. In fact, since the June 8th low in risk assets, we saw crude oil up approximately 6 or 7%, and we saw energy stocks down over 20%. Talk about a divergence. And then if we take a closer look at the energy sector ETF that we just referenced, XLE, on an absolute basis, prices continue to test a key level of support near 36. The more times a level is tested, the more likely it is to break, and boy was this level tested a lot of times. Additionally, to the point we made earlier, if stocks are rallying to new highs and crude oil is slowly but surely grinding higher, why can't energy stocks catch a bid? Well, in our view, it was probably a signal from the market that something was wrong. This divergence could have resolved itself in one of two ways. Either crude oil was correct and we were going to see energy stocks catch up and resolve to the upside, or we were going to see crude oil catch down to energy stocks. And given what we were seeing on a relative basis with XLE relative to the S&P hitting new all-time lows, our bet was that crude oil was the one that was ultimately going to resolve to the downside and play catch-up to energy stocks. And what else was Steve seeing that was supportive of this thesis? Well, one of the largest components of the energy sector, ExxonMobil, which recently got itself kicked out of the Dow for poor performance, was pressing to new lows, testing a key level of support once again near 39 and ultimately breaking that level. As I mentioned, Steve wrote that post last week as we're seeing continued selling pressure in crude oil for the first time in months. That brings us to today, where crude oil is sitting in the high 30s at 38 or 39, still stuck below support and resistance near 42.5, 43, Momentum is firmly in oversold territory, signaling that sellers are back in control. And the next logical area of potential support is down near 31. I know you're probably thinking, that's great, Tom, but what do I do with that information? Well, if you're trading crude oil directly, you have a very clear level to define your risk against. As long as prices are above those recent pivot highs near 43, the bias is to the downside and sellers remain in control. And even if you're not trading crude oil directly, from an intermarket perspective, it's important to keep an eye on due to its positive correlation with stocks and other risk assets. So, now that we're seeing crude oil resolve to the downside, that is a small potential headwind for equities as an asset class. Something to keep an eye on. And in terms of energy stocks, if there was one area of the market that was most likely to revisit its March lows, it's got to be energy. If this space couldn't get going when crude oil and equities were both moving to the upside and providing a tailwind, it's going to be very difficult for the sector to move higher in the face of an uptick in volatility in stocks and a downside resolution in crude. All right, let's quickly review and wrap up. First off, crude oil finally resolved its range to the downside. As long as prices are below 42.5, 43, the bias is lower with a target down near 31. From an equity market perspective, crude oil has shifted from a potential tailwind to now a potential headwind for equities and other risk assets. And then finally, on the energy stock front, if there was any area of the market you were looking to short, this is probably it. We're looking for a retest of the March lows in a lot of the major players and a lot of the major ETFs like XLE, XOP, and OIH. All right, that's all we've got for you today. If you enjoyed this episode, make sure to leave a comment down below. We love your feedback. And while you're down there, hit that like button and also make sure you're subscribed. That way you don't miss any more updates from myself and the rest of the team here at All Star Charts. Thanks again for watching, and we'll see you guys back here next week for another edition of What the FICC.